All right, guys, welcome back to the Independent Investor Channel. We're going to jump in and do a review of the self-directed Roth IRA account. Number one, this is my account. This account has just also surpassed the $100,000 mark. So we've got all three of our big accounts up over $100,000 following a very, very simple wealth building strategy of tax protection, especially in this account, and more importantly, wealth preservation. The nature by which you own your holdings is so much more important than the holdings themselves. So with that, guys, I'm going to drop you into the account and conduct the review. Another portfolio review for you guys. This is the Roth IRA account number one. This is actually my account. This is the flagship account that I own. It also went above 100,000 here recently again, so super excited about the performance in the portfolio, and thought I would declare a review for you guys for your enjoyment and benefit. This is established with a couple strategic goals. I personally have my S&P 500 exposure through my TSP, so with that, I kind of use that as a justification for benchmarking that portfolio and building this with a little bit more emphasis on dividend growth. So super important. I do seek out some foreign dividend exposure within this portfolio, so pretty exciting stuff. I do own a fairly large chunk of the Vanguard's high dividend yield fund, which is the largest position in this portfolio at about 20%. So pretty exciting position to own. When it pays a dividend, it's crazy good. It's nice to have that dividend income flowing into this and organically funding this as an account on its own without me having to always fund it from an exterior once a year, because I'm up against the $6,000 cap on this, and so it has to be able to generate revenue on its own and organically fund itself. And then eventually when I'm 59 and a half, I'll turn the spigot off and start to render some tax-free payments out of this Roth. So very cool stuff. Top end is Boeing, 20 share position. Obviously down in here, we're fine waiting this out long. I've made just a killer profit. So this down $850 is just a drop in the bucket from what I made on Boeing. It's been by far my largest trade of this year. It rendered well over $10,000 in profit in trading profit in Boeing, and just an awesome opportunity to own this company long. It is going to sort through all of what it's going through now, and eventually we will be looking back on this opportunity as just that, an opportunity to own one of the best companies in the world in the aerospace space. Next is Citigroup and financials, one of those fly under the radar financials. I think it's fantastic here. A great entry at the low 50s. Just a wonderful way to grab some exposure to one of the top banks in the world, Citigroup. I've owned this for a long time, and hopefully we can have some opportunity to build up this position. This is a base position, so I don't worry too much about this at all. I'll average into this position and look to accumulate shares over time. Next is Caterpillar. This is one company that I've just always wanted to just own. I want to be an owner in this company, as most of these fit that bill. These are companies that I just want to own for the long term. If they don't work out in my lifetime, then they'll work out in my kids' lifetime. It's totally fine. But a lot of these diamonds of the stock market, these are easy companies to own. Caterpillar, we're up a touch here. I think this is the whisper of infrastructure and coming out of what's been a pretty contentious relationship with China. So I think the drive up in Caterpillar has been quite nice, a nice dividend yielder, and can't complain there. Disney's come back quite significantly. One of the largest positions in telecom that I have. I think it's the only telecom holding in this portfolio. Yes, it is. So telecom communications, I've just become a recent subscriber to Disney Plus. I've watched Mandalorian for the first time actually last night. So really exciting stuff. It's nice to see Disney branch off of their traditional piece of businesses, but I was down well over 1,000 in this position, held true on it. I think I actually added a little tad to it to beef it up to 50 shares. We'll continue to add to Disney over the long term. It's one of those buy and holds forever. It really is. I'm not worried one bit about how good this company is. It's an easy stock to own and an easy company to invest in. FedEx, we finally got that, and this was more of an industrial play that I liquidated to reduce my exposure to industrials. It wasn't really based on my non-belief in FedEx. It was more of my portfolio positioning move to go ahead and liquidate FedEx and take some profits there. I went into some deep water with FedEx, got it back into the black, and we rendered some profits, freed up a little bit of cash flow in this portfolio, and we're holding that cash aside to monitor and take advantage of some other opportunities that may present themselves down the line. Home Depot's been on fire. I find it funny how companies like Tesla dominate the discussion most of the time, and nobody wants to come onto YouTube and talk about this Dow component. But what a beauty, up 10%! Holy moly! Just another phenomenal company that I absolutely wanted to own, and just an excellent company in the discretionary space. So we'll continue to own these shares long. Wish I would have bought more, to be honest with you. But, we've got a good, nice base position in here to add to going forward. IBM, we've added this nice position, helps to bolster the dividend income within the portfolio. Johnson & Johnson is the number one holding that I have in healthcare. It's been really nice. I need to add to this position. I'd love to get this over 10,000. Just as I go through here and earmark some of these strategic initiatives for the portfolio, those are just some of the things that I look at. Johnson & Johnson is always a freaking buy. You can fall into this company. If you were going to own one of 5 companies for the rest of your life, Johnson & Johnson makes that short list of companies that you could just buy and own forever. Own it generationally, no problem. I think if you're going to call yourself an investor, you should not be having a portfolio that is void of Johnson & Johnson. I'm that bullish on the company. It checks all the boxes for everything we could possibly want out of a company and then some. Just absolutely fantastic with a track record to boot and in the exclusive Dividend Kings category as well. Just a great, great company to own. And I would expect that my subscriber base has heard me many, many times talk about how incredible this company is and take that to heart. Next on the list, Kimberly-Clark. It's a great supplement to Procter & Gamble in the other Roth IRA. Kimberly-Clark is another one that while it seems that all of the discussion is on the growth side of the house and speculation side, it's amazing to me how these companies, this is rendered back 12%, nothing to shake a stick at, and it renders me a 3% dividend to boot. I'm not really sure I understand completely ignoring great companies like this, but I want to shed light on it for the few moments that I can during my portfolio review, and also say that Kimberly-Clark is one of the best companies that you can just buy and own long term. There it is. There it is. I've got it set up now in an established position. Really performed quite well, just over $400. I'm not really concerned with this at all. I'm really interested more so in building my share base in the company. And this is one of those companies that just hold down a slot in my Roth IRA and will continue to own it long and build the position. Next on the list is Coca-Cola. This is a supplement to the Pepsi position and the other portfolio. Nice dividend rendering, one of the few Dividend Kings as well. So that meets that exclusive list. Down a touch on the position, which is fine. We'll continue to own Coca-Cola long and continue to fund that up as we go forward. Next is McDonald's, ticker symbol MCD. I'm surprised to look at this before the review and determine that I'm actually up in the position. Took this down into some deep water. I don't know how low it went during the pandemic. I really didn't care. I'm fairly certain that I added to it during the pandemic. It's absolutely just a phenomenal company, one that I'm absolutely proud to be a shareholder in. When I first started investing, McDonald's was always one of those companies that you just had to own. And I feel that way about a lot of these companies, not only in this portfolio, but in the other Roth IRA as well. You can try to understand some of the strategic quality that I'm looking to jam into the Roth IRA accounts, because those really do have to stand the test of time. And that's one of those underlying goals that I try to meet when I'm doing these Roth IRA build-outs, is to put companies in there that can be bought and held forever. You can see most of these have already paid and have started the dividend reinvestment, but have started the compounding dividend effect over the holding. So really, really exciting stuff. McDonald's fits the bill and just always a good buy. Next on the list is Royal Dutch Shell. This is probably another pick that I'm more bullish on with the top three majors. I do own this in the Roth, which is the right place, being a foreign company. Man alive. This company has a balance sheet to boot. ExxonMobil, Chevron, and Royal Dutch Shell belong to be in the same discussion, and at $31 a share, I would take and almost be tempted to triple this position. I may take and double this position next week. So if I'm looking at opportunity here, again, I'm not too concerned with this, because my goodness, the dividend yield on Royal Dutch is still really quite good. Their balance sheet is really good. Money making, I think oil is basing here, if not already based, and actually building in some of the fundamental going forward for a rebound. Royal Dutch Shell is going to be in the discussion. Some of the targets on this, some of the analyst ratings on Royal Dutch Shell are off the charts, and for good reason. They're just out of favor right now. And if you're going to try to fight the tide of a market that seemingly gives all of the nod to a company like Tesla, as opposed to a company like Royal Dutch Shell, that's just investing. And sometimes things don't make a whole lot of sense. This doesn't make any sense, and neither does this, because I can value this company. I can't currently value this company. And we look at them with two different lenses. So where I would look at a Tesla and look at a Royal Dutch Shell, I would say that the opportunity exists in both, for two significantly different reasons, man. They don't even compare whatsoever. Raytheon Technology, I went ahead and increased this position. I'm super excited about this, man. The prospects of this company going forward, I believe this will be a $100 position easy going forward, and nice 4% dividend to boot. The Vanguard's value ETF has done quite well. It's rebounded nicely. I was down pretty big on this position, and not an enormous position in it. So relatively speaking, I don't really care so much about this being down a touch. I'm happy about the dividend that's being paid over the value, and very, very happy to own this as just a little dab of small cap exposure. I was pretty down on the position while it was underperforming, but now it's come back a little bit with value starting to show a little bit of sign of life in here. So that's exciting enough. I did skip over Tesla. You guys can see here this 2-share position will turn into 10 shares. Big whoop-de-doo. I'm really not as excited about everybody else owning this company. Big whoop-de-doo. I mean, I'll probably buy it at the wrong time and lose my pants. That's fine, I guess. I've never really been able to put a lot of companies in that holy moly category. Amazon, Google, Tesla, Facebook. Those are my holy moly stocks for the last decade. And I'm not going to sit on the sideline and allow my opportunity with a small spec position to go underutilized and leaving too much money on the table. If the company does adjust back, I'll deploy my discipline card on this. but I definitely wanted to establish a couple positions, take advantage of the 5-for-1 split. So we'll be sitting on 10 shares of Tesla in here. We'll be sitting on 10 shares in the taxable, and as well adding that just a tad back into the brokerage and the the M1 Finance account, so we can dollar cost average it a little bit. And if it does adjust back, there's enough cushion in the portfolio to to deal with that blow. You can obviously see here, I don't mind taking a position into a downturn. It doesn't bother me at all. The only drawback to taking Tesla into a downturn is that it doesn't pay a dividend, whereas Royal Dutch Shell does. But we'll see. Tesla seemingly goes up every day. I'm already up a whopping $3.70 in the position, so I'm super excited about that. And we'll buckle our seatbelts owning Tesla going forward. We'll see what happens. It'll be fun to track the position going forward. Relatively small position in the portfolio, so happy to own it. We'll see what happens. V&Q is the real estate REIT from Vanguard. Pays a nice dividend, building that position, and the same idea with utilities here, as I own the single stock utilities and the taxable, and I own the ETFs here within the portfolio. VYM, again, is the largest passive position. Nice 20% of the portfolio is tied up in this value play, and continuing to build that position out. A really nice diversified product. And then the baby sister to that holding is VYMI, which is the High Dividend International, which is also really nice too. Value's been out of play, so you can see here that they've adjusted back in value. That's totally fine. And then to round out the portfolio, Walgreens Boots Alliance, nice dividend payer, Dow component, WP Carey real estate REIT as well, supplements my realty income holding in the other portfolio. And then finally, Old Ironside with ExxonMobil. One of these days, this company's going to come back with a vengeance. So with that, guys, hope you appreciated the portfolio review. We'll kick you back to YouTube to conclude the video. All right, guys, so we've just come out of the Roth IRA account number 1. This is a self-directed account. These holdings are not perfect. This is not a perfect portfolio, but it is the nature by which I own this holdings that is the unique niche on the independent investor channel. These wealth holdings within this account are tax protected, and more importantly, they're wealth preserved, which means that I own these funds free of charge. I buy them free of charge. I dollar cost average them free of charge. I own them without any management fees over this account, and I will accelerate my wealth faster than anybody in a managed situation. Guys, if you appreciate the message coming through, you want to make sure and hit the subscribe button for us. Leave your comments at the bottom of this video. Share the message with anybody out there looking to take control over their own personal finances. This is the way we do it. We put individual investors in the driver's seat of their own money. Guys, thank you so much for tuning into the video, and good luck in your investment future.